joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. I've been focused lately in my weekly newsletters about the dramatic impact artificial intelligence is currently having on the equity markets, the continuously worsening global economic numbers signaling a U.S. recession is near as the global economy slows, and whether China will again save the developed economies from a hard landing. What I want to do in this session is attempt to tie them together. They are inextricably connected. As such, I want to cover the areas outlined here. Let's start with the euphoria about developments in artificial intelligence, which has captured the attention of corporate executives and investors alike. For corporations, artificial intelligence offers a solution to serious problems it has been facing as inflation crimps margins and pushes up labor costs, while productivity measured by worker output steadily falls. As I wrote in a recent newsletter, it was startling to hear artificial intelligence discussed during the Q1 earnings conference calls as a top priority to solve the productivity quagmire. IBM, for example, its CEO and CFO even announced the avoidance of hiring 6,000 people in anticipation of expected AI benefits. ChatGPT saw 500 million beta downloads almost immediately on announcement, with now over 1.4 billion downloads being used in the assessment process. These are unheard of adoption rate numbers. To the investment community, FOMO, or fear of missing out, has taken over as the gamma and momentum traders have enshrined AI as another tech bubble explosion to new heights. I don't want to rain on anyone's parade, but maybe we should examine some analytics underpinning all this before we start putting too much money on the table. As an old technology guy, my experience forced me to always remind people in situations like this to remember pioneers get arrows in the back. Is the AI narrative just getting started? If the current hype is real, and there is a strong chance it is, and I believe in it actually, then you have plenty of time to enter it at a better price to risk ratio. There is a strong chance the AI revolution will be fighting a recessionary headwind on overall stock market performance. Take full advantage of this. You might want to keep your powder dry. Most people underestimated the Dotcom momentum back in 1999. Most managed losing tons of money, first shorting the hype, later chasing it, before it all reversed and crashed. If AI is just hype or not, we leave you to decide, but one thing is sure, most people underestimate all big narratives, and trends tend to go on for much longer than most think possible. I am showing you here the proprietary Matassi crossbar index of the Big 8. You can see it gave us a sell signal for this big tech group in early 2022 and only reversed to a buy signal in January of this year. When we isolate NVIDIA from the group, you can see that the buy signal circle aligns with the real breakout of NVIDIA. This aligns with the sudden explosion in public narrative on artificial intelligence. These are tells of early narrative push that Wall Street is notorious for. The results have been nothing short of historic. The third largest single-day market cap gain in stock market history, as well as the best 10-year gain of any stock in history. The real tell in the market is the historic low level of market breadth. The Big 8 market cap stocks are carrying the market. We presently have 325 of the S&P 500 all trending down, while only 175 have an upward bias. Within that 175, we have the Big 8 carrying all of them. What is very unusual here is currently having a market rallying with small breadth. Typically, a bottom like this is a time to buy. We have to go all the way back to the dot-com bubble collapse shown by the red box to see a similar situation. This doesn't mean the current rally won't go on a little bit longer, but the coincidence is a significance worth noting. These are signs that historically have been very predictive because they are major reversals. This issue with the breadth is shown here with the Nifty 50 in 1972, the dot-com bubble in 2000, and where we are currently. I'm sure you've all heard the often used rationale, it's different this time. More money has been lost based on those words than can be imagined. It's always different in some ways, but the same in major ways. Now let me be specific and give you a couple of examples regarding the current AI euphoria. This is a chart going back to the lead up to the dot-com bubble in 2000 through to the current market rally. The red line is what is known as the PEG ratio. This is how you should view the current market situation versus a traditional PE ratio analysis. The PEG ratio is the ratio of the PE to growth rate. It tells you how much you are paying for the expected future anticipated growth rate, assuming, of course, dysphoria is well-founded. It shows us that we are paying for expected growth very near the level that peaked, the prices that the dot-com euphoria was willing to pay. The chart also tells us something else. Recessions truly matter. Prior recessions are drawn by the vertical gray boxes. Simplifying the chart, we see on the right and center that we are now at the relative forward P ratio for the S&P 500 technology group in 2008. That was a precursor to the great financial crisis recession. If recent history is any indicator, a looming recession should significantly temper this current AI euphoria. The only moment where technology was more expensive relative to the market was the era of 1999 through 2001. You will also notice the initial collapse of the dot-com bubble actually led to the recession, which followed in 2001-2002. Relative technology PE ratios fell to the current PE levels before falsely rising and then continuously crashing through 2013. Even a possible recessionary scare is not likely going to be handled well by today's overly leveraged and speculative investment climate. Looking at the 2000 dot-com bubble burst more closely, we show here on the left the NDX 100 when it hit its high in March of 2000. On the right, we overlay the reported initial jobless claims at the time in orange. Their high and low coincide almost perfectly before both abruptly reversed and moved strongly in the opposite direction. This is because the rise in initial jobless claims was seen as a confirming trigger that a recessionary impact were actually going to now be felt. Today, the initial jobless claim chart is again at historic lows, and therefore, even as Treasury Secretary Janet Yellen touts, you can't have a recession with jobless claims being at historic lows. As we saw in 2000, we need to watch for a sudden change in trend. We may actually have it. We need further confirmation, but we might just be getting the confirmation we want now. These numbers come out every Thursday, so we won't have to wait too long here. Let's look at another view of the dot-com bubble peak. Here we overlay the very reliable inverted yield curve predictor in turquoise, where once again the highs and lows align. The key here is that the yield curve must be inverted. It is not long after that once again both violently change as the economy goes into a recession. Today on the right, you can see once again we have the same setup. You look across the vertical gray recession bars, you can see how accurate an inverted yield curve is in predicting U.S. recessions. It becomes pretty clear that the identification and timing of a recession is of primary importance to us. With the market as represented by the major indices like the S&P 500 and NASDAQ rising, many are increasingly discounting this possibility. We believe that is a poor decision. One reason is in the understanding of the 2 quarters of negative GDP often cited versus the GDI and productivity measures seldom cited. You would think from May's blowout report the economy was booming. Here's the puzzle. Other data suggesting it is already in a recession. The dichotomy emerges from the divergent behavior of 2 indicators of economic activity, employment and output. In May, employers apparently added 339,000 jobs, bringing the total number of jobs added this year to nearly 1.6 million, a gain of 2.5% annualized. This, of course, if you believe the BLS numbers, which include the notoriously fictional plug number called the birth-death rate model, which was a net add of 231,000 from new businesses being created. I don't see new businesses being created. I see small businesses actually going under or cutting back. Contradictory, the real gross domestic income, or GDI, a measure of total economic activity, shrank both in the fourth quarter and first quarter. 2 negative quarters of output growth are one indicator of a recession. The economy has gone through periods where the output has expanded faster than employment, but seldom the other way around. We'll get back to this GDI in a moment. What explains this dissonant signals is productivity, or output per worker worked. It is cratering. That raises questions about whether the much-hyped technology adoption during the pandemic and more recently AI are making a difference. It also raises the risk that the Federal Reserve will have to raise interest rates more to tame inflation. Labor productivity fell 2.1% in the first quarter from the fourth at an annual rate and was down 0.8% in the first quarter from a year earlier. The Labor Department said that at least on Thursday. That is the fifth straight quarter of negative year-over-year productivity growth, the longest such run since records began in 1948. These calculations are derived from gross domestic product, which shows output rising at a 1.3% annualized rate in the first quarter. But another key measure, that is the gross domestic income I mentioned earlier, declined, implying an even bigger productivity collapse. GDI is the yin to the GDP's yang, measuring incomes earned in wages and profits, while GDP tallies up purchases of goods and services produced. In theory, the two should be equal, since someone's spending is another's incomes. They never exactly match, however, because of statistical challenges. Lately, though, the divergence is quite dramatic. Over the past 2 quarters, real GDP shows the economy expanding by 1%, not far off potential growth, whereas GDI shows it contracting by 1.4%, which amounts to a recession. The divergence is ominous. GDI previously undershot GDP dramatically during the 2007-2009 financial crisis and in the early 1990s recession. The second quarter is also shaping up to be weak. The S&P Global Market Intelligence sees second quarter real GDP expanding at a 0.8% annual rate. Morgan Stanley projects 0.3%. The Atlanta Fed's GDP now model estimates 2%. Most economists don't forecast GDI. Usually, employment plummets during recessions because as factories, offices, and restaurants produce less, they need fewer workers. That clearly isn't happening. If you look at the early 2000s, that was what was called a jobless recovery because employment took a long time to come back, even though the economy was growing. This time around, it could be the opposite. The economy could be contracting, but you're not seeing job losses. One reason could be labor hoarding, which I mentioned in a recent newsletter. After struggling to hire and train workers during the pandemic-induced labor crunch, employers are now balking at letting them go, even as sales slip. Given the labor market's unusual tightness, there are 10.1 million vacant jobs in April, well above the 5.7 million people looking for work that month. Some firms, particularly services such as restaurants and travel-related businesses, ran short-staffed for the past couple of years and are still trying to catch up. A possible sign of this is hours worked per week, which in May fell slightly below the 2019 average, after having surged during the pandemic. This drop has been particularly sharp in retail and leisure and hospitality industries that have been especially strapped for workers. The unemployment rate also rose in May, one sign of a potential cooling in the labor market. It's not that the technology got worse in the last year, but the businesses were selling less stuff, and they're nervous about their ability to attract employees, so they're holding on to their employees. It is also plausible that the shift to working from home generated a hit to productivity whose impact grows with the cumulative loss of creative exchange and mentoring. Productivity growth is important in the long run because it is one of the two engines of economic growth, the other being an expanding workforce. Businesses have been spending on equipment, software, and intellectual property investment that should eventually raise productivity, though it may take many years, so should recent advances in artificial intelligence. A more imminent concern is that when workers produce more, companies can raise wages without increasing prices. When productivity falls, it is harder to keep inflation in check. This could make things even more challenging for the Fed. Companies probably have the ability to pass on higher prices to consumers if they want to. That would be problematic for the Fed. Moreover, if GDI is a better indicator of output than GDP, it would mean that the economy has slowed more than we had thought without bringing down inflation that much. That might mean it will ultimately take an even bigger economic pullback to bring inflation down. People are just not realizing that. On June 5th's weekly newsletter, we laid out 3 drivers that have now, in our opinion, basically cemented a U.S. recession. We labeled them as the trifecta. 1, a liquidity shock by increasing the funding of U.S. Treasuries general account. This is a result of the massive increase in the U.S. debt ceiling and government spending to a rate or greater than required to maintain stability through the COVID-19 pandemic. 2, slow overall global growth, falling productivity, and inflation, though falling, still at persistently elevated levels. 3rd, the unexpected slow reopening of the Chinese economy from its COVID lockdowns and a Chinese credit impulse being insufficient to once again save the global economy. The importance of the Chinese reopening from the COVID lockdowns is, in our opinion, being underestimated and underreported. In fact, we recently released a video on this subject because of this, and how important China has been over the last decade in stabilizing global economic growth and helping in avoiding a recession. Since the release of that video, the news out of China has only been increasingly more disappointing. The video highlighted the importance of the economic policy shift in a focus to consumer consumption. Chinese consumer confidence is only marginally improving and insufficient to deliver the economic surge needed. According to Morgan Stanley, Chinese macro surprises have only further worsened. The all-important Chinese real estate market is still in a quagmire, and if anything, is again showing signs of further weakness. Our opinion is that China is not going to save the U.S. economy from a recession. Matter of fact, we are concerned about Chinese ability to save itself. What are our conclusions? We believe the recent passage of the Fiscal Responsibility Act to increase the U.S. national debt ceiling has not only locked in a U.S. recession, but a protracted era of stagflation for the U.S. economy. The approved increase in the debt ceiling screens from the public the following urgent needs. 1. The visibility to understand that promised Social Security and Medicare benefits are unsustainable, particularly for the youngest Americans who are currently compelled to fund benefits for older Americans in a coercive, basically Ponzi scheme. The resolution to be less likely to support costly foreign interventionism, to include the more than $113 billion already spent on a proxy war against Russia in the Ukraine. More Americans would question the premise that their security is impacted by who controls Ukraine's heavily ethnic Russian Donbas region. 3. The motivation to toss aside the rose-colored glasses through which they view big spending proposals, like last summer's $375 billion package to fund a crony-enriched and chaotic battle against climate change. 4. The motivation to apply greater scrutiny to military spending and more people questioning why the Pentagon should spend more than $7.3 trillion over the next 10 years, and more than it spent in the decade that encompassed the peak of U.S. warfare in Iraq and Afghanistan. And 5. The motivation to cast a harsher eye on thinly disguised vote-buying schemes from student debt cancellation to reparations for black people and increasingly disfavor all varieties of wealth distribution, from subsidies for Iowa farmers to illegal aid for Israel. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems, until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They are strictly for educational and discussion purposes only. As negative as these comments often are, there has actually seldom been a better time for investing. However, it requires careful analysis and not following what may have traditionally been the true and tried approaches. Do your reading. Make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2023 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.